This is Optimal Finance Daily, episode 2009, Beating the Market, 4 Ways to Outperform Index Funds, Part 1, by Stephen Keyes of tripofalifestyle.com. And I'm your host and personal finance enthusiast, Diana Merriam. I have a bit of a longer post today. I'll read the first half today and finish the rest for you tomorrow. So let's dive into the first half and start optimizing your life. Beating the Market, 4 Ways to Outperform Index Funds, Part 1, by Stephen Keyes of tripofalifestyle.com. When I buy shares of VTI, Vanguard's total stock market index fund, I get a tiny slice of almost every publicly traded company in the United States. I own a piece of the entire stock market. Historically, this type of low-cost index fund has delivered an average return of 10 to 11% per year. That's enough to double my money every 7 years on average, or to turn a single foregone new car purchase into $1 million in 35 years without lifting a finger. Some fans of index funds insist that there's no way to beat them. Active mutual fund managers brag that they can easily outperform the S&P 500 and other stock indexes for a fee. So who's right? Well, the truth is somewhere in between. Let's look at 4 ways to beat index funds that actually work over the long run and the disadvantages of each one. Note, we are not financial advisors. We're just a couple of bloggers honestly sharing what's worked for us. This article contains personal opinions for your consideration, not professional financial advice. Number 1, beating the market with higher risk investments. If someone offers you a low risk, high return investment, that person is probably a liar and/or an insurance salesman. Risk and reward are intrinsically linked because of something called the efficient market hypothesis. It basically says that financial markets are super competitive. So the moment that any abnormally amazing opportunity pops up, droves of investors or Wall Street computer algorithms will flock to take advantage of it, and that opportunity will instantly disappear. To understand this better, imagine if there were only 2 investments available in the whole world. Investment A costs $10 per share today and is guaranteed to be worth $20 in 5 years. Low risk, high reward. And investment B costs $10 per share today, and in 5 years, you get to flip a coin to determine whether it's worth $7 or $20. High risk, high potential reward. Which would you choose? You shouldn't even have to stop to think about it. You'd buy investment A immediately, and so would everyone else on planet Earth. In fact, investment A would be purchased so quickly by so many people that its current price would skyrocket beyond $10 until it was about equally as attractive as investment B at its new price. This is exactly what happens in real life. Lower risk investments are bid up to higher prices, which tends to depress their future returns. Higher risk investments may be less expensive today, which provides more room for potential growth in the future. In other words, risk is automatically priced into all assets. There's good news though. If you're willing to take extra risk, you can give yourself a chance at beating broad index funds. There are a lot of ways to do this, some good, some bad, but I'll focus on 2 that I think have merit. The first strategy is to shift from total market index funds into higher risk versions. For example, you could trade a portion of your position in VTI or an S&P 500 index fund for VB, a small cap US stock market index fund instead. Historical data shows that smaller companies often beat the market by a little bit over the long run, with more volatility and risk along the way. Similar swaps might include trading some VXUS, our favorite total international stock market index fund, for VSS, a small cap international stock market index fund instead. Or trading some BND, our favorite total US bond market index fund, for JNK, a high-yield junk bond index fund instead. If you still want to take more risk, another strategy that can boost returns is to use leverage in your investment portfolio. Using leverage just means taking out a loan and buying investments with the proceeds. In other words, buying investments with other people's money. Leverage multiplies investment returns. For example, if you invested $100,000 into an S&P 500 index fund and earned 10%, you'd make a $10,000 profit. But if you borrowed another $100,000 to invest, you'd earn twice as much, minus the interest on the loan. Real estate investors use mortgages to achieve this. For example, by putting 20% down on a series of mortgages, you could buy $1 million worth of rental properties with only $200,000 of your own capital. Here's the problem. Leverage multiplies returns in both directions. When your investments are making money, it can feel great. But when bad times come and the market takes a dip, your losses will be amplified too. Depending on how much leverage you're using, a market crash can actually bankrupt you. Personally, we've never made use of leverage in our own portfolio. It's just too risky for us. Number 2, taking advantage of inefficient markets. The efficient market hypothesis applies to stocks and bonds because they're traded in highly competitive, purely financial global markets. That makes it almost impossible to gain an advantage over other investors, even for experts. And it's also why buy and hold index funds are generally the best option in those arenas. But that's not true of every investment. Imagine finding a beautiful house listed for sale by owner in a rural part of Montana. It's been on the market for a month, and you're only the second person to actually check it out. The owner of the property is moving to a beach house across the country for retirement next month and really wants to use cash from the home sale on a yacht. As a potential buyer, you have several advantages going for you. There's practically no competition from other bidders. The owner is under pressure to sell within a specific time frame. Personal factors, like that sweet, sweet yacht, are at play in the seller's mind, which might cloud their judgment. And the property you're bidding on is non-fungible and thus difficult to price accurately. All of these things increase your chances of successfully landing an amazing deal and scoring the house at a huge discount to its fair market value. And none of these advantages would be possible in a more competitive, more efficient marketplace like the public stock market. To be continued. You just listened to part 1 of the post titled Beating the Market, 4 Ways to Outperform Index Funds by Stephen Keys of tripofalifestyle.com. I'll admit, when I saw the title of this article, I was a bit skeptical. The large majority of investors don't beat the market over the long term, though it's very possible to do it over the short term. But I was pleased to see the suggestion here to tweak a portfolio rooted in index funds. It reminds me a bit of the work I've seen from Paul Merriman, no relation, who talks about a simple 2-fund for life strategy. There's also the Boglehead's 3-fund portfolio that's widely respected. These are great, well-researched ways for long-term index fund investors to optimize their portfolios. So why don't I do this? At this point in time, it's simply because I'm a very lazy investor, and I'm happy with matching the market to meet my financial goals. I like to focus more on asset allocation versus deciding which specific funds to keep in my portfolio. This is because all reasonably well-diversified 100% stock portfolios are going to perform about 90% the same. Likewise, all reasonably well-diversified 80-20 or 60-40 stock-to-bond portfolios are going to perform about 90% the same. Sure, I could probably do a better job at optimizing my portfolio, but I see much more value in a hands-free approach where I focus more on how much I'm investing versus the returns of those investments. I had a listener write in not too long ago and questioned why I was investing my HSA in Fidelity's zero-fee total market index fund when there was another fund with a 0.015% expense ratio that performed better over the last year by 0.04. The way I looked at it, these 2 funds over time are going to perform about 90% the same. So I'd rather just stick with one versus constantly monitoring them. Plus, even though this other fund's performance seemed to justify the fee in 1 year, it's not likely to justify it over 30 years. Well, that should do it for today. Have a happy rest of your day and a great weekend. And I'll see you tomorrow, where we'll finish up this post and where your optimal life awaits.